Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And now the question comes, all right, my slides are going, so, now the real question comes is, what do we start to look for? How do we find one of these trades? What are the issues that we need to overcome here? Well, some key criteria in finding a good long straddle / strangle here. We need to look at implied historical volatility for a particular underlying. We want to look for perhaps price consolidation patterns that give way to intentional movements. We need to make sure, as I mentioned, that the underlying prices and liquidity of the ETF are present, and that the ETF options and that underlying ETF also have reasonable price spreads and liquidity. Once again, that goes hand in hand with the cost that we're putting on, because we have to overcome whatever it costs us to put that on through the movement. We need to think about our timing. By that I mean, how far out do we want to go? And then think about once we have the position on, is position management as far as the time remaining for the expiration of the options. We need to make some decisions as these options move towards expiration. And this last thing we need to think about, maybe not the last thing, maybe it should be the first thing that we think about, to be honest, is the event. What is setting us to the point to say this is a good opportunity, or this is an opportunity that perhaps a straddle or a strangle could be profitable for me? Is it in fact a news event? Is it earnings? Is it geopolitical in nature? Is it price consolidation? Is it just a chart pattern? Is it a chart pattern that indicates to me that we're poised for a breakout? We're not sure in what direction. Certainly there are consolidation patterns that do that. You can look at it and say, this might be a good opportunity. Once we've decided what the opportunity is, we want to look at where we want to go with it, and then we start to go through the analysis of, are the options on this particular underlying okay to use. So we need to look at our ETF. Does it have a track record of being able to move the distance needed to make the straddle profitable? Not all ETFs, just by their nature, because most of the, I guess, market ETFs have a number of securities in the index under them. In general, that tends to flatten out a little bit of volatility, whereas obviously the commodity or single currency ETFs don't have that issue. But when news comes out, when earnings come out, does it move? How has it moved in the past? This is a little bit of that history. You got to go back, take a look at the charts, look at the volumes, and think, because quite honestly, there are some that don't react the same way. Same with individual securities. So does it, if we're going to need this thing to move 6 points up or 6 points down when a particular set of news or a particular chart pattern, if it breaks out of a consolidation pattern, what did it do the last time it broke out one of these patterns? If it only moves 3 points, well, we're not going to put on a straddle for 6. Or we're going to think hard about it, let it put it that way. Are the options inexpensive on a historical basis? What is the historical volatility? What is the volatility now compared to where they've been on a historic basis? Once again, you get caught if you get that expensive option, because that is going to raise your cost, and your cost is where you need to get out of the movement you need to go. And we need to have the options a little bit liquid with relatively tight spreads. I'm not talking penny wide here, but something comfortable that if we get the move we're looking for, we can certainly get out without giving up a lot of the profit because of the bid-offer spread. Sometimes that is a frustrating thing in dealing with options. I will readily admit that. It's very, very frustrating in some cases when that happens. So things to look for in strong candidates. What's the storyline? Broad market news, you anticipated it can cause a big revaluation. Chart patterns, I talked about momentum, underlying index looks oversold, overbought, island reversals, breakouts, ETFs that have had big price swings in the past that we would want to be stepping into. We're expecting implied volatility to rise. And then our implied volatility currently, though, is looking lower than realized volatility. And I think this might be a good opportunity to talk about that implied volatility and option pricing and timing. One issue that came up a lot when I was doing, the education and out for the exchanges and stuff was, folks, this is a strategy is a good candidate for having people getting frustrated over this particular issue, rather, is that I put this straddle on. Everything played out exactly the way I planned it to. It worked out. The thing took off like a rock and everything. Yet the underlying option didn't move anywhere near what I thought it would move based on the price movement of the underlying. And that can be extremely frustrating. The scenario that sometimes will play out there was that the implied volatility was pushed into the option premium ahead of the event. One reason, market makers, just like anybody else, are looking at the risk that they take in making a market. They tend to be net sellers of the options. If we're looking at a particular event occurring in, specifically, let's use that, or a breakout, they see that as well as you do. So they're going to get some money for their risk. They're going to increase that implied volatility, push the premiums up. So that going into, prior to the event, you may be angled a little bit higher for those options. That's why you need to look at historical and implied. And then what happens is the event occurs, and certainly the underlying moves, but once the event has occurred, the need for that higher implied volatility is no longer there. The risk is sort of out of the trade, if you will. So it starts to come in. The implied volatility, option pricing model, the option premium will not stand as fast because the volatility number is not as big. Doesn't mean to say that the option prices will not increase. Of course they will if the underlying goes up or down, depending on whether it's calls or puts. It's just that, yes, they will probably do less than we had thought they would do. And the reason is because of this volatility change. You'll still have a profitable trade, but it is frustrating. No. One way to kind of look at that is again, go back and see what has happened in the past. If something has happened, when does this volatility start to enter into the equation? Does it start 2 weeks prior to the announcement? It started already as the stock consolidation pattern had come together, or is it getting smaller and smaller rather than the volatility slowing a little bit as you get that consolidation? Has there been sort of an uptick in it? Everybody makes their own decision at that point in time whether I really want to get into the trade or not based on that. But it's certainly not a reason not to do a trade, but it is something you need to be aware of and have that expectation on the back end of where these prices will go. One way to do this is obviously an option pricing calculator is to sit down with this and put in some values and see where they're coming out. And say, you know what, even if the volatility comes off X%, if I do it at this number, I'm still okay with my return on my investment, that type thing. So once again, looking at volatility conditions in general, is it low compared to the average over the medium term, 3-6 months maybe? Implied volatility lower than historical over the last 1, 2, and 3 months? How can we kind of look at this a little bit? Well, let's look at the overall market volatility, and this is where when I started at the beginning of the presentation, I said conditions right now recently have been very difficult to deal with in that because it's not normal. Well, sometimes it actually looks like it's getting more normal, but point being that it is extraordinary market conditions, extraordinary global economic conditions, and things get skewed during that period of time on that. Look at the industry sector. And does it look like it's poised for higher or lower volatility? We're clearly using the VIX as kind of a gauge of where we are in that fear factor and the, that to determine what we think volatility is right now is way high. Market gets high, like I said at the beginning, like it has recently, where it's been extremely volatile. Option premiums are going to ratchet up because everybody's a little bit scared. So the straddle, strangle, in those conditions, you may be biting off a little more premium than you need. But again, doesn't mean you can't take advantage of it. Continuing in that path, it's just a caution flag, as I would say, in that case. Technical analysis considerations. As I mentioned, triangles, pennants, indicating that the historical volatility is declining. Is the implied volatility declining as well, or is it starting to, creep back in? Generally, those patterns do precede some sort of a breakout. Once again, we don't care. As long as it breaks out and it goes like crazy, and this is where we go back and say, did this occur before? Has this particular ETF demonstrated this after a chart pattern like this at a previous time? Just wanted to show you this one here and give you some idea about trade considerations, because I stumbled across this chart. Actually, I got it sent to me by a friend of mine who deals in currencies back when. But I looked at it and said, well, geez, this is a great example. And there you go. There's your consolidation pattern. Japanese yen, it happens to be dollar yen. And, he even said, this looks like it's poised for a breakout. I don't know which way or how much it'll go once it breaks out, but it is definitely poised for something. So now you look at it and say, well, there you go. There's a consolidation pattern that looks like it would work for one of these. Now what do? We look at the yen ETFs, and this is where, because there are multiple levels of ETFs dealing with almost the same thing out there, it gets a little dicey to kind of select which one. But I do think that once you start an overlay of looking at certain volumes and certain things, it'll pretty fall out which ones are the more popular, which ones are the ones you would want to play in. So you have the three. Actually, it becomes relatively easy with these three because only one of the ETFs has options on it. But there's another play here. And my friends at the ISC have their foreign exchange, their FX options, and they have a Japanese yen option, UK. So there's another way to look. It doesn't necessarily have to be the options on the ETF, but they're certainly available. And if they meet the criteria, it's certainly worth staying within that. But if you're comfortable with the FX options and have the ability to trade those in the account, it's something else to look at, to consider. And that's why I say I call it stuffy pencil work. Select the trade with the best potential for success. And you want to look at liquidity, volume, the history of movement. I kind of repeat myself. But there you go. There's a chart pattern not that old. That certainly sets up an opportunity to look about it. So think about it again. I'm buying two options. So those premium costs are going to be a major factor. Premium are driven by the volatility and the liquidity. So you want to keep those in mind. We need to move outside that box, the total premium paid. This lower historical means incrementally lower premiums. Just standard, that's options. That's the way we work. So the lower net cost that we can trade on reduces the move needed and overall. The Greeks, as far as the delta of the option, much less impact on the straddle because we've got one call and one put, so we've got a plus and a minus. And the delta offsetting each other, as we move through the trade. Theta, time decay, as we mentioned, impacts negatively. Vega peaks at the at-the-money strike, indicating a small increase in volatility. It's a positive move, increases the value of the straddle, and that's what we said. Implied volatility increases are your friend, and they're going to increase both of these options. Exit strategy. So what do we do? If we're playing a particular news event, some sort of surprise news, it could be court rulings, it could be something coming out on a product, it could be, again, earnings perhaps, in that. If it doesn't happen, we need to exit. And this, again, it's part of that timing issue of when do we want to get in this prior to the news event. No hard and fast answers here. You just want to keep looking at that volatility, but you don't want to wait till the day before they announce their earnings, because at that point in time, you're pretty sure that anything in the way of increased implied volatility is pretty much going to be there. After the news event surprise and the price does move, one option here is sell the profitable side, keep the other in anticipation of a retracement or a rebound. May not get back to even here, but you may be able to get something, because usually you do have that quick move back and then a drop back a little bit on it, which would bring the price of the other option back up a bit. However, once again, because of time value, you need to consider closing your open position on either side if you decided to keep that. For example, with less than 1 month, because you are now getting into the time decay, let's say, to trap a little bit with it. And as I mentioned, factor in the post-news volatility shift, which I talked about before, where after the news comes out, they don't need that much volatility anymore to mitigate the risk, if you will, because it happened and the ETF has done what it's going to do, basically. And then you need to do that when you sit here anticipated, because it's all expectations. If you anticipated saying, hey, well, if the news comes out and goes up 10 points, this thing should be worth X, and it's X minus a little bit, you get very frustrated with that, because maybe you need to factor that in and say, well, okay, we'll take off a little bit. We'll have our expectations set realistically here. Giving enough time for the expiration for the strategy to work. Once again, the further we go out in time, we have that issue in the premium as well, not just the implied volatility. We have the time premium that tacks on. So where do we look? I've always said 3 months is a good area, not a hard and fast rule. Certainly could do it, 45 days, that kind of thing. If you do it with a month, be prepared to exit quickly, and hopefully it occurs, but be careful of implied volatility. Acceleration begins. I can't, keep hammering on the time decay scenario, but it is important to have in the back of your mind. Once again, those of you that are more experienced in the options trading side, I know this is set up for folks hopefully getting used to this and willing to spend some time with a simulator, looking at Straddles and Strangles and getting a feel for it if they work. The experience. Time decay is there. We're used to it. You'll get used to it as you get into options. It's important to consider. It's not the only thing to consider. Maybe not. It's not the one thing to say, oh my gosh, it's a month ago. I got to close this position out. Let's hold back and look at what the whole picture here before we do that. On that. So greatest risk is theta, with the one exception if for some reason that implied volatility, when we talk about this, factoring in the post-event volatility, if for some reason it plummets, or it plummets before this, because the event now becomes a non-event, if you will, those premiums are going to vanish anyway. So be prepared. Once again, we're on the long side. Let's just remember, we're long. We bought those. We established our maximum loss from the front anyway. So if we start to see this stuff, obviously we can exit prior, hopefully recover a little bit of premium from it. Consider a preset profit target. When it's reached, exit. Don't say, well, that was easy. It's probably going to go higher. Let me hold on. And then they get caught up in the classic, let's hold on to this because, geez, I made my profit target. I put it on for 3 months. I made my profit target in a month. I got at least a month left before time decay starts to really hit me. So why don't I just stay with this? And then all of a sudden things start to pull back as they tend to do, and you watch that number start to go away and get really, really upset at yourself on that trading plan discipline. Okay? And I said time decay is something to consider. It'll take your profit away a little bit, and volatility contraction. Okay, let's now really quickly get into. I got a question here, Jeff asks, what is realized volatility? It does mean it's just another term for historical volatility. On that, probably should use historical and not realized, but sorry about that. Let's just do a follow-up because you've got the position on, and there are, as with everything else in the options world, probably an option you do here when you have a multiple leg strategy on. So our original position along the March 50 straddle for 6 points for simplicity's sake here. The ETF jumps to 55. The March 50 call has gone to 7. The March 50 put has gone to 1. When we look over and we see the March 45 put is trading at 3. So What's a possibility? Well, if you do nothing, stay the course, and see if it continues on the upside, take that profit on that side. We can sell the call, take the profit, as I mentioned, hope for the pullback, and premium comes in a bit. However, this does cut off our potential upside profit. What can we do? Perhaps to adjust this position and still remain in the game if we've got an upside. So we adjust the position is a suggestion which you might want to look at. We sell the 50 put for 1, buy the 45 put for that 3. Our new net cost basis is 8, however, but the combination will be worth 5 at expiration, regardless of the ETF, since the put is 5 points higher than the call at this point. If the ETF finishes above 55 or below 50, it will be worth more than 5, just a pure intrinsic value. Okay? This follow-up action has not limited our potential profit. If the ETF continues to rise, the call becomes more valuable. If the ETF falls, the put will gain in value. So by making this follow-up, we haven't limited our profit potential. Our risk exposure has improved. The most we can lose is 3, since it costs 8, and we can be sold for 5 at the worst if we just at expiration, just for the intrinsic value. If the ETF moves up in the next strike, and this is just a summary, consider rolling the put up. If the ETF goes on the downside, we'll roll the call down. We just do the reverse of what we just did. Excuse me. So that's a potential. It becomes what is known as a combination at that point in time.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.